Please join me in a warm welcome for Katerina Lisenkova.
Thank you, everyone. Thank you for inviting me to speak at this exciting event. Thank you for Elliot for introduction. He actually stole a few of my best lines in his first speech, so if it doesn't work out as well as I hope, that it's his fault. Then it's my first visit to the Channel Islands. Enjoyable so far. Hopefully the weather is going to permit me to leave it tomorrow. Also, Elliot had a very good introduction about the Brexit and gave you the Brexit update. Again, I'm not going to talk a lot about it. If there are any questions, please, they're very welcome. I'm going to start by saying that in the days and weeks and months like we are in the middle of this Brexit discussion, it's very difficult to keep your eyes open for the wider trends. We focus ourselves on something that is immediately in front of our eyes, and we talk about it and we discuss it, and it clouds our vision. It doesn't allow our curiosity and our intellectual capacity to look beyond what is going to happen over the next couple of hours in the Parliament. But I want to urge you, as business people, to use different lenses when you're looking into the future. Not only look close to where we are, also sometimes use a telescope to look a little bit to the stars and see where we are headed. But I will start with today, where we are today in the world in economic terms. And we had a few good years. So this is GDP growth in G7 countries and in the world over the past 2 years. And we had, as I said, not bad time. Especially 2017 for G7 countries was good, except Britain. Britain is a special case at the moment. For the world, 2018 was remarkable. 3.8% growth in 2018, the fastest growth since financial crisis. So healthy growth, everybody's happy, but it was 2018, the year when people started asking the question, what's next? Have we reached peak growth? Is the next recession around the corner? And I will talk you through some of the risk factors that crystallized in 2018, appeared in 2018, that made people ask those questions, that made us ponder what's ahead of us. And I will start with well, this is going to be non-exhaustive list of risks, but the big ones that I can identify, and I think they're important for you because they influence everybody around the world. So I'll start with the country, which has disproportionately important role in economic terms in the world, with the United States. What happens in domestic policy in the United States doesn't stay within the borders of the United States, it spills over to the rest of the world. That's why we always pay attention to what's happening in the United States. The chart on the right shows you the GDP growth in the United States, and it also shows you the moment when the US chose to have fiscal stimulus. At the beginning of 2018, they introduced the fiscal stimulus through cutting taxes and increasing government spending. Many economists were surprised by the choice of policy. This was an unconventional choice. At the time when the economy is growing, some people say the economy is growing at above potential, and the monetary authorities are tightening monetary policy by increasing the rates. At this moment, administration introduces a fiscal stimulus. Unconventional, to say the least. What did they want to achieve with this? They wanted to achieve remarkable growth, and this is what they got. In the second quarter of 2018, US was growing at annualized rate of 4.2%. For a mature economy like US, this is astonishing. But it didn't last long, and the growth started to slow down in the quarter 3 and 4. Overall, in 2018, the growth was 2.9%. Still very fast and healthy. One of the reasons why the growth started to slow down is because the Fed, the monetary authority, they were saying economy is overheating. We cannot allow it to happen because then the recession is going to follow. And they started to increase the rate even further and even faster. 4 rate increases in 2018, which obviously slowed down the growth somewhat. The chart on the right, yes, it's on the right. So the chart on the right shows you the internal effects of this. So most of the stimulus materialized in the deficit. The pink lines show you the forecast for the fiscal deficit just before the stimulus, and the purple lines show you the deficit forecast after. So you can see that immediately, the difference between this forecast is 1 quarter. So within this 1 quarter, the conditions have changed so much that the deficit has increased quite substantially. Actually, if we look at the first 4 months of this fiscal year, which started in October 2018, so we have the data for the first 4 months. During this time, the deficit in the United States increased by 77% relative to the same period last year. So this is kind of self-inflicted problems. But why do I say that it matters globally? It's not just for the US, obviously. If they just did it to themselves and they got a few quarters of very fast growth, good for them. Why does it matter for the rest of the world? So the Fed started to increase the rates. What global effect did it have? The capital started to flow in from emerging markets to the US. Emerging markets were capital starved, their currency depreciated, a lot of them had dollar-denominated debt, which was put them in a very tricky position, to say the least. Argentina, South Africa, Turkey in particular had a tough year because of that. Argentina had such a tough year that it had to go to IMF for help. So this is me saying, what happens in the US, the world is going to fail. The next area which everybody is looking at is China. Second largest economy, what happens there also matters globally to other countries as well. The growth in China was slowing gradually. In 2018, the growth was 6.6%, very high by our developed world standards. But for China, this was the slowest growth since 1990. Imagine now, 30 years of absolutely unprecedented growth. For most of this period in double digits. And now they are in a period of transition to the more sustainable, locally sourced growth, where the main driver for the future expansion is not going to be external demand through export, but internal demand through consumption. So the slowdown in growth is not a surprise. Everybody is expecting this. The question is whether authorities are going to be able to, what we economists call soft land the economy, to move it from the period of very rapid expansion to some slower growth, which is going to be sustainable in the long future. So far, they're doing not bad, and they're managing this transition quite well. But then the United States had its own plans, and they said, we're going to help you a little bit along the way, and they started the trade war with China. Trade is very important for China. They still depend on exports for a lot of the growth. This chart shows you where we are at the moment with the trade war. So in 2018, US introduced tariffs on about 50% of what it imports from China, and they threaten another 50%. Currently, they're in a state of what they call truce in this trade war, because there are negotiations and they're trying to achieve the deal that is going to be acceptable for both sides. I have to say China doesn't have a strong hand in these negotiations, because if you look at the bottom there, the Chinese China already introduced tariffs for almost 100% of what it imports from the US, because obviously the volumes are not the same. And the reason the stated goal of this policy was to narrow down the deficit that US has with China, because it was too wide. If this was the goal, US is failing on this goal dramatically, because 2018, the deficit with China was the largest on record. They completely missed the goal that they set themselves. Why is that? Partially, this is because China, at the same time when the US was introducing tariffs, started devaluing its currency. They said, if you do that, we're going to take other measures. So they devalued their currency quite substantially, which means that when tariffs go higher, the prices for US consumers not necessarily go to the same extent, due to the fact that the currency is devaluing now. But this is not the end of the story, so we don't know how it's going to continue, what is going to be the outcome of the negotiations that are currently underway, and also the trend is worrying going forward, because the next target that the US administration set itself is India. So now they're saying that they don't want to extend the currently existing preferential trade agreement to India, and they will start kind of reviewing the situation and the trade with India next. So this is the second area to pay attention to. And the third, Eurozone. We cannot avoid it. It's close to us, and it affects everybody here as well. This map shows you the interest rate on the 10-year government bonds. And it classifies countries into 3 categories. Even if I didn't show you this map, you would probably yourself be able to tell me which countries go into which category. There are 4 Eurozone countries, as we call them, strong economies in which the markets have good confidence and they have low borrowing cost. Starting with Germany, which has the lowest among the European zone countries, the lowest interest rate, and then all the countries surrounding it, Scandinavian countries, and France and Ireland. Ireland actually joined quite recently. Then the next tier are 2 countries which have moderately higher borrowing cost, Spain and Portugal, and then there are countries which have significantly higher borrowing cost, Greece and Italy. And to give you the flavor of how different the borrowing costs are between these countries, in Germany it's 0.4%, in Greece it's 4.2, 10 times. So the order of magnitude higher borrowing costs that the Greece is facing when it goes into international markets to get, when the government wants to refinance its debt. But I'm talking a lot about Greece because Greece attracted a lot of attention. Greece has a debt of 180% of GDP, you know, and many people talk about Greece. But it's not Greece that worries me the most. It's Italy. Why Italy? Italian debt is about 130% of GDP, so lower than Greece is. But it matters much more than Greece because of its sheer size. The size of Italian economy. Italy is one of the G7 economies, so one of the largest economies in the world. Therefore, if you have a debt of 130% of GDP, it's much larger volume of debt that they need to refinance on a regular basis. And every time the attention of the markets turns back to Italy, the spread between the German and Italian bonds is widening. So the first peak you see on the chart on the left, this is the sovereign debt crisis in 2012. It didn't start in Italy, it started in Greece, but it very quickly spilled over to Italy because investors started thinking, oh, by the way, how is the Italian situation? Now, the Italian situation is not great. There is no growth. The country is kind of stagnated for the last 20 years. So, again, the spread widened. The second peak, which you see on this chart, which happened in 2018, and this is what I wanted to talk to you about. So it just happened now. When the new Italian government came to power, and they started negotiating the deficit with the European Commission, and they had a dispute over it, because they wanted to increase the deficit, and the European Commission wasn't happy with that, because they have certain rules. The minute it happened, Italy is on the front pages of the newspapers, everybody's paying attention again, boom. You have the spread between the government bonds in Italy and Germany to increase. And this is not going to disappear. Because the underlying problem is not being solved. And from time to time, it will flare up, and we just all constantly paying attention of what's going on in Italy because it matters quite a lot. So all of these risks that as I highlighted, they create this environment of a high uncertainty. So we can say we just live in the world of high uncertainty globally. But then Britain has its own source of uncertainty, Brexit. It's not going to have a global effects, but it will be felt quite significantly inside the UK. And this chart, I'm showing you one of the measures of uncertainty that you can use. When the Monetary Policy Committee sets its interest rates, it also makes the forecast for the economy. But the way it does the forecast, it sets the distribution of different outcomes, of different paths that the economy can take. And this distribution, like here I'm showing you 90% confidence. They say there is a 90% chance that the growth is going to be between A and B. And the distance between A and B has been widening. Before 2008, it was 3.8%. During the period of 2013-2016, it was 5.3%. and after the referendum on exiting the European Union, now it is 6.7%. So the confidence of the Bank of England about how the future growth of the economy is going to work out is declining, and the spread of these outcomes is increasing. Another thing to notice on this chart is that the highest growth that they think is achievable is not budging. It's on the same level. So all the risks that they perceive, they're on the downside. They say that the probability that the economy is going to go into the recession is increasing, but the probability that it will have an extraordinary growth is actually not increasing. So all the risks are in the downsides, which is not how we want it, which is not what we want for the economy. And if UK goes into recession now, let's fantasize, let's think about it. Or should I probably say not when the UK is going to go, not if the UK is going to go into the recession, but when it will go into the recession. Because we know the recession is coming. We don't know when it's going to happen. We don't know how deep it's going to be. But it will eventually come. The problem that Britain and many other countries around the world, actually most of the advanced countries have, is that we don't have much firepower to fight those recessions. In terms of the monetary policy, the bank rate is very positive. If you look in terms of the real bank rate, it's negative. We live in a world of negative real rates for almost a decade now after the financial crisis. So we have no firepower in terms of the conventional monetary policy to fight the next recession. If we're looking at the fiscal side, do we have room for the fiscal stimulus? The deficit is declining. The bars are showing you the deficit and the forecast for the deficit for the next couple of years. Yes, the deficit is declining, and it's forecast to decline further. But if you look at the level of the debt, it's 75% to GDP is current debt in the UK. At the time when the financial crisis came, the debt to GDP ratio was 35%. And if your debt to GDP ratio is 35%, it's much easier for the government to take a decision for large-scale fiscal stimulus than when your debt is already 75% to GDP. So I'm just saying that our instruments of conventional policy that we can use to stimulate the economy to come out of the deep crisis are quite limited. And they're going to be quite limited for some time. Therefore, I'm just saying that if the recession comes, if it's a deep recession, expect some unconventional measures to be taken. You will be surprised about how this is all going to work out. And now I want to switch to the lens. We were talking about close events that are happening right now, that are going to work out in the next couple of years. And now let's switch the lens and look at the big trends. They're happening right now as well, but we sometimes choose to ignore them because they're so big. And big things are sometimes very difficult to notice when they're so close to you. But we need, and the businesses, you as business people, you always need to look at those big trends and remember what they mean for you. I'll start with population aging. This is a chart from the website, the Government of Jersey website. This is population projections created by somebody here or maybe commissioned somewhere else. And it shows the different scenarios about the dependency rate that the Jersey economy is going to have. Dependency rate is the ratio of people who are not working because they are too young or too old relative to people who are working. And this dependency ratio is forecast to increase. So the speed is uncertain depending on the scenario, but the trajectory is very clear. We know the direction in which we are going. The population aging is a global trend. Everybody is going to experience it. It's not specific to Jersey, not specific to UK, even not specific to the advanced economies. Developing world is aging as well. Here, the different lines show you what will happen depending on the migration rate. And another thing I want to tell you. So the reason the dependency ratio is increasing, they do not tell you because they don't decompose it on children and older people. But I can assure you that the increase is not because you are having a baby. Yeah? So it's not the younger groups that are increasing, it's the older groups that are increasing, in particular people in the very advanced ages, 85 and above. And we need to keep this in mind. Why is it important for companies? You need to answer yourself 3 questions, and you need to keep asking those questions of yourself and answering them to yourself. Who are your future workers? Your future workers are going to be older. Your future workers are going to potentially change career in the older years and not have the same career across the whole life. So this is the future we're going to live in. Who are your customers? Your customers are getting older. Their requirements are different. The goods they're buying are different. The services they demand are different. We need to constantly remind ourselves that our today's customers are not going to be our tomorrow's customers. Don't forget about that. And the third question, who is going to pay for it all in terms of taxpayers? If the number of people who are working and actively paying taxes is shrinking, and the number of people who demand public services, who are usually people in the advanced stage because of the social care and the health care is increasing, the cost to the system is increasing. The number of choices that we have is rather limited. Either we are increasing the taxes, which nobody wants, or we have to admit that we will not be able to provide the same level of services that we have at the moment. So there is, there isn't much else that can be done. So the next big trend I want to bring to your attention is climate change. This is the map I got from the report on climate change in Jersey. Very interesting report. If climate change is an interesting topic for you, I urge you to read it. What it shows is that if the sea level increases by 1 meter, which is forecast to happen by the end of the century, then these arrows are the areas where there will be erosion of land. These are the kind of risk areas. The second map shows you if you do nothing, if you do not create the barriers, if you do not protect yourself against the water, this is what's going to happen to the coastline, right? But you will tell me, it's by the end of the century, 80 years. It's too long a distance for any company to take into account and prepare for. I want today to convince you that the change is going to happen much sooner than the end of the century. And for this, I'll show you this chart. This is the forecast of greenhouse gas emissions. The black line shows you what the trajectory of greenhouse gas emissions was. And then there are 4 scenarios of how it can develop from now. So the red one at the top is we do nothing. We continue to live in a high carbon world. And then the greenhouse gas emissions are increasing. If we do that, the forecast is that by the end of the century, the warming is going to be 3.7%. 3.7 degrees Celsius. Within the Paris Agreement, 200 countries signed up to the limiting global warming to well below 2 degrees. Well below 2 degrees is not a precise number, but if it's 2 degrees, then the yellow line is the trajectory we should take in order to be able to stay within 2 degrees. Later on, IPCC published next report that said, well, below is not a precise number, but it's better if it's 1.5. Then we will be able to avoid some of the worst effects of global warming. So 1.5 is the dark blue line at the bottom. If we want to stay on 1.5 degree line, we need to reduce our greenhouse gas emissions by 1/4 by 2025. You see, this is not within the time horizon plan of any companies. This is very much within the time horizon of the businesses. And to be able to do it, the second type of effect is going to kick in. What we economists call transition effects. So the physical effects are easy to understand. Physical effects of what everybody is thinking about. Rising seawater, warmer temperatures, extreme weather events. This is easy to understand, but they're not happening right now. Well, transition has to happen right now. Transition are the measures that we as a society are taking to be able, for us to be able to reduce greenhouse gas emissions and stay on those preferable trajectories for the future. And they're going to come on all different shapes and forms, but primarily regulation, legislation, litigation, changes in consumer behavior. This is going to happen now, and I predict there is going to, the pace of change in this area is going to accelerate. Now, I'll give you just one example. In 2015, the same year when the Paris Agreement was signed, the Financial Stability Board, international organization comprising the G20 heads of finance and heads of state, they created the body which is called Task Force for Climate-Related Financial Disclosures. This task force, by 2017, came up with recommendations. What companies have to disclose to investors and other stakeholders in terms of their climate risks. And it puts these disclosures into 4 categories: governance, strategy, risk management, and metrics and targets. This is voluntary disclosure, so company can choose whether it wants or not wants to do this TCFD disclosure. RBS was making these disclosures from the beginning. We already done twice in our last year annual report and this year annual report. But it's voluntary, right? So first of all, you may choose not to follow it, and secondly, even if you choose to follow it for some reason, you can choose what the kind of information you're going to give. But in March this year, Prudential Regulation Authority, which is one of the monetary authorities in the UK, comes up with requirements. And these requirements are going to be aligned with TCFD. They're going to concern only banks at this stage, because the PRA is regulated for banks. But they're going to be mandatory. The banks will be required to disclose certain information related to their exposure to climate risks. How is their balance sheet looks like with respect to the different climate scenarios. And if banks are going to be required to do it, it's very, very quickly is going to spill over to the rest of the economy, right? Banks will need to, first of all, gather information, which at the moment we do not do, but we will have to start gathering this information internally and externally from our counterparties. When we start measuring anything, it changes your behavior. Because you will probably want to do better than the other bank. You know, there is competition in everything, and you don't want to be on the kind of red flag above you say you are not very good at the climate risk. So you will start changing. It will start changing the behavior of the banks. When it starts changing the behavior of the banks, everybody is going to be affected because banks are holding the purse strings, right? But this is, again, you cannot fail the disclosure. You are disclosing this information, everybody is taking notice, but you cannot fail it. But the Bank of England is planning to have stress tests, which include climate-related risks. And when you have a stress test, you can fail it. If the bank fails it, higher capital requirements and other assumptions are going to follow. So banks will do whatever it takes not to fail it. And obviously, the spillover to other countries, the companies is going to be very quick. So I just urge you, if climate change is not on your radar, put it there. If it is on your radar, move it up a notch, because the change potentially is going to happen very quickly. And then the third big trend I'm going to talk about is the post-industrial revolution. Automation, AI, machine learning, all the exciting things that we all like to read about in the news, about how amazing the world that we are moving forward is going to be. It promises a lot of opportunities. It promises a lot of opportunities, but also generates quite substantial risks. And today, I just want to talk about some opportunities and risks that I can identify. So the biggest opportunity is that it potentially can generate fast growth and high productivity improvement that the advanced economies were lacking ever since the financial crisis. And at the same time, at low price. So you can have more for less. What's not to like? This is the dream of any any economist around the tables. But with those opportunities come some substantial risks. Risks in the form of what are we going to do with our workers? If AI is going to be very successful in substituting the humans, what will we do with the population, potentially a substantial proportion of population which is not able to find a gainful employment in the economy, and how will it all influence the distribution of power and distribution of money. You know, if the big four companies, which are going to, at the end of the day, either develop or buy all this AI technology that is being developed by other small startups at the moment, and they're going to hold all of this and concentrate all the benefits, because the benefits are going to be very concentrated. Benefits are going to be among those who are owning this technology, while the costs are going to be paid by everybody. The costs are social, while the benefits are private. We need to prepare ourselves for this future world and think about the policy that will allow us to maximize the opportunities and minimize the risks. To be fair, we're not very good with that. I mean, in terms of policy, looking ahead, we're not great. And I don't hold my breath, but we will have to enact some kind of policy changes for this new world of artificial intelligence. Starting from the education policy, because as I said, we will not just have a profession for life. And that's why the education system, the structure that we have at the moment, when you're learning a lot in your 20s and then that's you done until you retire much later, this is going to cease to exist. You will have to start changing your professions. Potentially, you will be changing professions into something that didn't exist as a profession at the time when you were in your early 20s. So this is the world towards which we're moving in a way. That's why our education system will be completely revamped for that. Second one, obvious, which is taxation. How do you deal with the distributional issues? How do you make those who are benefiting the most to share with those who are hurt the most because of this transformation? This is going to be tough. I mean, the companies, the ones that I mentioned, the big four, Googles and Amazons and Apples of this world, it's very difficult to tax them because they're already stronger than any individual administration in any country on earth. This will require some kind of coordinated effort, and we're at the moment in time where we speak, we have very good coordinated efforts. So I'm almost finished my talk today. I want to make a short quiz just as an interesting finish to my presentation today. I'm going to show you a picture now, and I'm going to read you a paragraph of text. And I want you to think, how is this picture connected with this text? I have to tell you. So I'm making, this is my 9th presentation last 2 days. So far, so it kind of gets me close to 200 people who listen to me. So far, one of them guessed halfway, 50% right. So I give points for 50% right. It's also very good. So you have quite a lot of pressure on your hands to perform well in this quiz. So that's the picture, and listen to the text. Asked to clarify the reports, a spokesman for May said, the Prime Minister has made it absolutely clear her intention is to leave the EU as quickly as possible, and that will be under her negotiating mandate, as confirmed in the Queen's speech last week. Any guesses how is this picture related to this text? Do I see lots of hands? No takers? Okay, I'll tell you. But you failed. I'll tell you. So both this picture and this text were generated by AI. This person doesn't exist. This text wasn't written by a human being. It was written by a machine, by an algorithm that was asked to write something about Brexit. And it wrote something that is absolutely coherent in the context and can be a real story, but it isn't. And this photograph is of a person who doesn't exist. If you do not believe me, go to the website, which is called This Person Does Not Exist. Every time you refresh the page, it generates a new face for you. Some of the faces look strange. You can see that it's a machine done something wrong. Many of the faces look horribly good. horribly in a sense, scarily good, like this. I mean, and it doesn't take you a long time. So in a couple of clicks, I was able to generate 5 different faces, which were good enough to show to the audience and ask you what you think. So you wouldn't guess that it looks anything strange. So there you go. This is the level of AI we are at the moment. Are we aware of that? We are not aware of that. How can our policy catch up with these trends that are unfolding at such a speed? Thank you for your attention, and I'm happy to take questions about this or anything else economics related.
So thank you, Katerina. I can assure you that I exist, and I'm sure you do too. So, as usual, Q&A. Please put your hand up. We've got a roving mic or two. Say where you're from and a question for Katerina. Okay, I'll start with the first one. So, you talked a little bit about the dependency ratio in Jersey. We also talked about productivity and AI and automation. What's in store for us here, being a jurisdiction that is primarily taxing individuals? We do tax some businesses at various different percents, but a vast majority of our taxation comes from individuals. What's in store for a jurisdiction like ours of 105,000 people?
Yeah. Thank you. It's a good question, and it's nice that people start putting these two trends together. Because we usually talk about them separately, and we talk about the population age in isolation of our AI revolution, which is unfolding at the same time. And one of the problems that people identify usually, yes, the population is aging, therefore we'll have not enough workers to support those who are not working. AI sorts this problem. I mean, the question is at which pace both of the processes are going to happen, but eventually, potentially, this is a complete solution to the problem of population aging and having not enough workers. For places like Jersey in particular, where you have limited territory and limited taste for increasing population indefinitely through immigration, this offers an opportunity to sort out this problem. You are at full employment, so you have no situation where you have many spare hands on offer to fill in new jobs. The very correct question is about what about the taxes, but this is not about, it's not just Jersey, it's everywhere else, because we will get into the situation where taxing incomes from labor, from work, is not going to be working very well. If you're going to be kind of shrinking number of people in work, the proportion of people in work, we will need to find different sources of taxes. What these sources of taxes are well known, but as I said, it's going to be difficult to convince those sources of taxes to share. And the taxing businesses will become a strategy that, however unpalatable for your jurisdiction is, this is where the future is heading towards.
I've seen talk about not just taxing profits on businesses, but also taxing robots.
Yeah, exactly. So they are not businesses, but the businesses are going to be owning those robots. So it's and by robot, what is meant not necessarily a physical robot the way you see it in the old sci-fi. So the AI that wrote this text is a robot. It's a kind of digital robot in itself. So there are propositions of taxing digital services, taxing artificial intelligence algorithms when they come on stream. Currently, all these discussions are in infancy, but we will have to learn very quickly because the pace of change in this sphere is very quick. There is an expectation that, actually, as I speak right now, the Chancellor of the Exchequer is making his spring statement in the UK, and there is an expectation that he is going to be talking about taxing or restricting the big four, and also taxing the digital kind of processes as well. So this is the first. I'm not saying he's not the first to come up with the idea, but this is like the first springs of this topic which is going to come up more and more as we move forward.
Thank you. Questions from the floor, please. Okay, there we go. David, the mics are coming over to you.
Hi, fantastic talk, really, really interesting, thank you. Well, I'm in the copper business, okay, so you talk about environment, global warming, that's potentially, you already know, is going to have an impact on our industry and our ability. Just interesting on the financing side of that, you know, you're talking about banks now having to have a look at who's on their books, who may be hit by global. Does that mean businesses like mine are going to find it more difficult to raise funding in the long run? Is that going to be the impact we're going to see?
I think this means that it depends on what you mean by difficult. I think most of the businesses will still be able to raise funding. The question is the cost of that, right? So the higher usually how it works in finance, the higher the risks, the higher the price for funding. So this is and climate will enter the list of the risks against which the banks will be checking any deal that they are entering. So I think, and in this respect, yes, some companies, some sectors, and some projects are going to be finding the funding costs are increasing.
Okay. Another question, please. There's plenty out there. There we go. Ronnie's got one over here.
So thank you for an excellent talk. What do you see as the biggest threat to the longevity of the current banks and those people that look after the money?
So many. Well, the AI, which we are talking about, is already very well integrated into the banking system. You know, all these challenger banks which are appearing out of nowhere, which are able to provide high level of services from an app, not require big bank book of customers, and they disrupt the banking system. The biggest counter-argument to that is to say those challenger banks, they're all not profitable and they're not going to survive for long with this business model. My answer to that, they don't have to be profitable for them to disrupt the normal bank's business model. So we will see a lot of the risks, because when a customer becomes accustomed to something for free or very easy or from someone else, they will start demanding the same level of services for free or very easy from the big banks. And we need to run just to stay still at the moment.
Okay. Time for one more question? Yes.
Thank you very much. Germany, I think, just avoided recession last year. Do you have any thoughts on Germany's ability to prop up Europe with the absence of the UK economy contributing to it?
Yeah, Germany, just avoided, you're absolutely right. They claim, and many commentators claim that these were one of the events connected with the emissions scandal that was unfolded last year, which is also again connected with the climate change issue we were just talking about. I think you can conflate two questions, because Britain is not propping up the Eurozone countries because we're not in the Eurozone. So Germany is underwriting, well, European Central Bank, but virtually Germany is underwriting the debt of the likes of Greece and Italy at the moment, saying European Central Bank said that we stand behind and we're the lender of last resort. We will come to help when if they're going to get stuck. So in this respect, nothing is going to change because Britain wasn't part of it. But Britain is part of the European Union, and it is a net contributor to the European Union. So when this money are going to run out, if we are going to leave the European Union, it will become more difficult for other European countries, those who are the donors, or it will become more difficult for the countries recipient of those funds. Yeah, it will create problems for them. I don't want to try to quantify how big the problem is for them relative to how big the problem in the UK. I think that the level of what Britain was getting in return for the money that they were contributing to the single market and the European Union were good value for money, in my opinion. But withdrawing this funding, they are going to create problems for them.
Okay, please join me in thanking Katerina Lisenkova.